Guys. So we'll go ahead and get started. I appreciate you guys showing up, the ones who are live. I know it's the holidays and this is real difficult to sneak these kind of meetings in, but as you know, if you're not able to stay the whole time, it is being recorded. I will send it out to the same email list. But for anybody who's watching the recording, I'm pretty excited about the conversation that we're going to have tonight because it's been a hot topic for a while. So I'm excited to share more about it and obviously hear it straight from someone who is doing this for a living and not my version of what I think it is or what it is. So, for those of you who don't know, I am Beth McLaughlin McDonald. I've been a private money lender for about 2.5 years. And in my first 6 months of being a private money lender, I recognized that there were some shortfalls in the processes, the follow up, the communication. And as you probably know, when someone else has your money and you feel all of those things, it's a little unsettling. So I decided to start reaching out to borrowers. I started reaching out to lenders and just asking them about the process, asking them about, redeploying their funds with current borrowers they were already working with and what that experience was like. And basically, what I was finding from both the borrower and from the lender is that they would do a deal together and then everybody would move on. And in my opinion, that's just too much work. Like we're all here to make more money, right? And we want our money to grow. And whether you're a borrower doing the hard work or you're the lender watching someone else do the hard work, we're all here to grow our money and create our legacies and that type of thing. So I kind of inserted myself in between the borrower and the lender. I have 35 years of corporate America, processes, procedures, operations, all of those things. And I recognize that there were some huge opportunities to kind of close that gap and help borrowers and lenders create more of a community and more of a rinse and repeat process so that they could continue working together rather than both of them going their separate ways and starting from scratch with every new deal. So I've been doing that for a little over a year, and I am hoping to close out the year at about $10 million raised. So that's a lot of ladies, helping a lot of ladies reach their goals. Thanks, Lucas. I appreciate that. Lots of women being able to reach their goals, whether they're the borrower or they're the lender. It works both ways. So in that process, I have learned and I have grown. I started with gap funding in the 20 to 30 and 40,000 range. And then I had somebody throw a $500,000 deal at me. Now I've had $1.2 million deals thrown at me. And, it's just fun to watch it kind of grow and to watch these communities of women helping each other. In fact, I have a borrower who had about 4 or 5 lenders on a deal with her. And one of those lenders is now partnered with her doing a project together. And some of the previous lenders are working and lending on their project together. And that's my goal, is to create these communities, again, of the rinse and the repeat, of trust, of friendships. We all know it's business first. And we all have to do our due diligence no matter what. Disclaimer here. But it's just amazing to have ladies reach out and say, okay, I'm getting my funds back. What else do you have? I'm getting my funds back. Where else can we put it? Hey, I want to do this now. I want to do this now. And it's really awesome to be in the middle of that. So in this process, I have, of course, worked with multiple mentors. And one of my mentors in one of the groups that I'm in is called RPM with Amy Majori. And that is raising private money. So at the beginning of November, she held her summit in California, and I was fortunate enough to have a very deep conversation, but confusing for me, conversation with Lucas with GrowIt regarding syndications and that aha moment of where have you been the last 6 months. This would have been really helpful to know a long time ago and understand a long time ago. It would have helped more borrowers. It probably would have helped even more lenders. So with all that said, growing into this space, I'm finding that more and more lenders are looking for the more slow and steady, the longer term opportunities to have their funds grow for them. And I'm finding more and more borrowers are looking for those same types of deals to offer lenders. And working with Lucas, like I said a few minutes ago, it's been an eye opener. I've learned a lot. I was super intimidated by the word. just in general, just syndication in general, because I just thought that was something other people did, more professional, like more advanced, more experienced people. But I'm learning a lot. Not a lot, not enough to teach this myself or demonstrate myself. So with all that said, Lucas, super, super grateful that literally about 4 hours ago, I shot you a text and was like, hey, what are you doing at 8 o'clock tonight? And you even had your office Christmas party tonight. So, again, super grateful that you are here. I'm excited for people to learn who you are, why you do what you do, and then we'll go from there. So, if you would like to do a little introduction, the floor is yours.
Perfect. Thanks for having me, Beth. And I did have to reread your text twice. I think I saw it and I was working away, and then I read it and I was like, oh, she means tonight. I was like on a call.
I was sweating
Uh,
a little because I didn't hear back from you, and I was like, Lucas is usually really responsive. I figured you were on back-to-back calls. I know how that goes.
yes. Well, great to see everyone tonight. My name's Lucas, and I co-founded. I'm the CEO of GrowIt, and we make real estate syndications easy. That's what we're looking to do, and affordable, and make sure you're compliant and not scary. We believe it's a great vehicle, and we're going to talk about why today. But first, I think it's important to share like my story, and how what you all are doing is something that's very relevant to my life story, which is my both my parents came from nothing. We had like very little growing up, and they invested everything in real estate. And my weekends were spent at a apartment complex that they would buy. And we kept buying apartment complexes as they, rolled everything into real estate. And so I learned about real estate from, 5 years old. We were self-managing. We were not using other people's money, or we were not raising money, or investing in other people's deals. That was kind of foreign at the time. And so, anyways, I grew up around real estate, and then I became a lender. I don't know if Beth knows this, but I was a loan officer straight out of college, at a company called SoFi, and learned, at 21 loans, Fannie, Freddie, Jumbo, all licensed in 26 states. And then I led a big national sales team. And so I really learned how to use debt to finance deals. Again, like this was, the bank's money, but, relevant to what we're going to be chatting about today. And I learned how to put deals together and help people, create winning situations for both sides. And I really, loved that. And then I started building my own portfolio. So I'm not just here telling you to do something that I haven't done myself. I, have my own portfolio across the Utah market, where I used to live. And I was running out of capital. I realized that like I needed to, begin raising money, whether that be through promissory notes, or my own syndication. And so I actually started with my own syndication. And I spoke about this at length at the RPM conference a couple weeks ago. So I won't go through those slides just to, unless it's relevant later. But I had my first deal, and I thought I was like killing it. Right. I was like, oh my gosh, I thought about this 90 days ago, and now I've got a deal under contract, and people offer me $2 million. And at the end of the day, the deal didn't happen. And the reason the deal didn't happen was because I didn't understand how syndications worked. And so I didn't have anyone guiding me. I had no mentor of like, here's like the right way to run a syndication. Here's the legal structure you should use. Here are the legal docs that you need to use. Here's the right firm that should write those docs so that they are um, compliant, enforceable, comprehensive, understandable to both sides. Also, here are the compliance regulations you need to follow. It was scary. I think so many people tell me, like, Lucas, like, this is kind of a scary word. I was like, yeah, I know. I used to be there, but now it's not scary because I've done a lot of work, and now I do this for a living. And then also from a banking perspective, what banks will bank these types of deals. And then, okay, like if I've got the deal set up, how do I onboard my investors? What do I need to do to have a smooth process? And so, anyways, I grew up in Silicon Valley, and I spent my whole career in tech, and I built banking products. I built credit card and lending products. I built software for all of them. I was in lending at SoFi. And so, and I sold securities. Like I had all the securities licenses, the highest that you could have in the US. And so I was like, wow, like when my deal blew up, because I ended up not doing it because it was the 11th hour, my EMD was going hard, and I was like, I like this was just too much and it was going to be really expensive and I didn't know if the deal was going to go through. And so I decided to call off the deal and that was not good for me and it was not good for my investors. Everyone, it was a big bummer. And so, I sat back that week and I was like, what do I want? Like what would have helped close this deal? And the answer was I figured it out. It just took me too long to get there. It was too expensive. It's going to cost me $40,000 to get set up upfront, um, which was not palatable. And then, it was just way too much of my time, right? It wasn't stuff that I liked doing. I wanted to be working with finding a deal, executing the strategy, and then finding, investors to fund my deals that could benefit from the passive income that it would pay out. And so I left and I co-founded GrowIt. And our mission is to help humans achieve financial independence. And I think it goes back to like what Beth and I always say, we're very mission aligned and everything that you all are doing. I hear the words legacy, passive income, lifestyle, all ties back. Like that's why, when Beth asked me a couple hours ago, I'm like, we've spent a lot of time together. Like I want to be a part of this because everything we do is, trying to help more deals happen so that you have more opportunities to invest your capital and keep it invested, in good deals so that you can achieve your goals. So I've lived losing a deal firsthand, and I said I'm going to spend the next 10 years of my life solving that problem and making it easier for folks like you to either do deals if you're a borrower. I see Robin's on the call. Welcome. Good to see you again. And then also, if you are a lender, being able to invest in those deals. And so what we do for folks like Beth and Robin, whether you're a capital raiser or a borrower, is make one, demystify the whole process. That scary word, like, what does that mean? Okay, how do I set up a deal? How do I stay compliant? When should it be used? All of those things. So we do all that. And everything that you need is in one place. And so Beth is able to go in one place, come to us, and she's going to work with one person to set up the deal. And then she's able to use our investor portal to invite you in a one streamlined process. You're able to go through a couple of compliance checks, sign your documents, transfer your money, and see your investment or investments all in one place. And actually, in the future, you'll be able to receive all of your payouts, whether it's paid monthly, quarterly, annual, etc., in one. You'll be able to see a full track record of that in your GrowIt account. And so this will really be a hub for you to be able to see all of your investments. So that's my story. And Beth, feel free to jump in before I share a little bit. I know Gina asked about the structure, but I just wanted to make sure it was clear that, this is a problem that I think some folks in this room maybe have experienced a lost deal recently. And I've experienced it too. And so that, I wake up every day wanting to, make that not be the case again.
I would agree. All right, Gina actually has her hand raised. Go ahead, Gina.
Okay, so is there a certain like minimum raise? Like, is syndication for a certain dollar amount? Can it be used on different asset types like RV parks, apartment buildings, or is it, I guess, what are the defining parameters for this is when I would need syndication?
Yes, I'm actually going to cast them because I want to answer that and talk about the structure because you had asked about that earlier before we started. So you could, so in, let me answer your question by explaining this slide, Gina, and then I'll come back and answer it directly. So when we say syndicating, what that really means is that we are setting up, or whoever's raising the money is setting up an LLC in Delaware. And then they're selling units in that LLC for $1 a piece. So Gina, if you want to put in $50,000 to the deal, you are going to subscribe for 50,000 units and you get 50,000 units in exchange for your $50,000. And then you own a piece of that holding company. So you don't know exactly what percentage you're going to get because, Beth could be raising $1 million, but then the loan could be upsized to 1.2. So it's going to, once it's all fully raised in our platform, we'll show you what percentage you own. But really you're putting in money in exchange for a piece of an entity. That entity then goes around and let's say this entity is raising $1 million, this holding company. That entity then goes and makes an investment. That could be buying a piece of real estate. You mentioned a number of different subsectors within real estate, Gina. Does all of them are fine? You mentioned, I think, RV, self-storage, multi. We're at, as long as you're doing real estate, we've got all the legal docs and structure that you need to support you. Or it can be used to make a loan, as a primary or first mortgage, with a mortgage or deed of trust, that's the collateral. So really it's syndicating is pooling money together from a group of people to then deploy in one chunk into an investment, whether that be a loan or a piece of property. You technically could do syndications for other asset classes too, but I think today we're focused on real. You can do it for a business as an example, but today we're focused on real estate. And so what happens is investors put money into the holding company, and then the management company makes all decisions for this holding company. So Beth, as an example, she's the capital raiser, is the manager of this management company. So she is able to make decisions for the holding company. In exchange for her services, putting together the deal, making all the decisions, making sure taxes are done, making sure your payouts are received, working with the borrower to make sure that they're paying if there's a loan, etc. She gets can receive certain fees, or can receive a portion of profit, right? So whether that be um, we can get into that, but like there are different ways that can be monetized. To compensate her for putting the deal together.
And
Uh,
remain SEC compliant.
I got a call from the SEC bureau chief last week telling us, you do so many deals with us, and our team loves you because they're good files and you're keeping people compliant. So, yes. So that is syndicating is really people put together money into a pool through an LLC, and that LLC writes a single check into an investment, and it's managed by a management company, which can be run by one to multiple people. At the highest level, that's what a syndication is, Gina. I want to stop there and see if anyone has any questions on that structure or if that is clear. So investors, if you are a lender here, if you lend money, you would be an investor. Those words are synonymous here. And you own 100% of this LLC. The manager owns 0%. The manager in the operating agreement, and we're going to walk through what's called a waterfall in a little bit, receives they're compensated through a share of profits in the future, or a specific fee that's in the document, like could be like an origination fee for the loan, that can be paid whether it's from the borrower, typically by the borrower. So
Lucas, can
that's
I
what.
pause for one quick second?
Yes.
Okay, perfect. Denisa, you had come off mute a second ago. Did you have a question?
No, it was probably like silly question. So you are the management company, right, Lucas?
We set up the management company for
But
Beth,
you
and
are
then
not the management company.
no, there's a new management company for every deal that is run by whoever the capital raiser is the management company.
So if it's the
Okay,
borrower,
understood. Understood.
if the
So,
borrower is raising their own capital, would they qualify in one of those slots? Or is that not SEC compliant that they're raising money for their own deal?
Sorry, can you say that one more time? Like if the borrower is raising, say that one
Since
more
you're
time.
so like Robin, for instance, could Robin just come to you and say, "Hey, I'm raising all my capital by myself," and then do the same structure? Can
Yes.
Robin be holding and or management company and then deploy the funds into her own deal?
Yes.
Okay.
And so if Robin wanted to do that, the structure here is exactly what we'd set up for her. We would set up a management company in whatever state Robin lives in, and then she would be the owner of the management company. Then she would make decisions for the holding company. She would raise that same $1 million, and then instead of lending the money to her, she is going to through a property company, she's going to buy her RV park. So there will be another LLC that's in the state of the RV park. That's just for liability purposes. It adds extra protection. It's a very good thing, um, and protects your capital even more. And so this would be, let's say this was in Missouri. This would be a Missouri LLC, and that LLC would buy the RV park and obtain the loan.
Got it.
Gotcha.
So you can technically have, one of these feeding into another. We do it all the time, right? You could have a capital raiser raising for another capital raiser. You could have multiple capital raisers raising for someone. Like Robin could be doing a deal and say, well, it's a bigger deal, a $3 million raise. She could say, I'm going to raise $1 million, but then I need two capital raisers to each raise $1 million for me. And we would set up a whole new structure for the capital raiser, right? That way it's, you're running your own deal. And then once you have your million, you would write that as become an investor in Robin's deal.
Very interesting.
And when you raise that 1 million, for example, can you use it for multiple investments, or does it have to be each time, like each, let's say, property or project is like one management company, or can one management company? Yeah.
I follow.
We'll stop there.
Great question, Nisa. The answer is we can set it up such that you are able to make multiple investments if you as the manager indicate that's what you want in our product, right? So if you're like, hey, if Denise, you're raising money and you know that your lenders are going to be comfortable with that or want that, you can request it and we'll do it. Like we have the right, it's a different version of the docs, right? So, but let's say Beth is raising and she's told you, hey, we are going to invest in this RV park. And once the money comes back, I'm going to distribute it back to you. Then the docs are going to say that. They're not going to say that she can reinvest the money somewhere else. But if she wanted to and disclose to you like, hey, I'm going to raise the money and I'm going to, make a loan here and I'm going to make a loan here, they can be written in that way. So you can make multiple investments in one deal if you are using the proper set of documents, which if you tell us up front, that's what we'll provide you. But it's very important that, we're told these things up front and we ask those questions such that like you are properly disclosing to your lenders, what the offering is. Yeah.
There's a question also, and actually I had this in my notes to ask you, but we'll go ahead and ask it now. So Sarah is asking what other companies are like yours, for an example. Just maybe they've heard another company name, or maybe you can talk a little bit about the differences between what you guys do and maybe what other people think you do. Or we can get to that later if this isn't the right timing.
No, totally fine. Um, there's a company called Avestor that does something similar, Avestor. They're more like a fund of funds model, or I think they call them customizable funds. Um, we can talk, we're strict, like straight up syndication, and they're creating a bunch of entities underneath another one. And some folks that I've known that have come to us from them, so it creates a lot of complexity come the tax time. And here, like it works for certain people if they have the same investors that want to do a ton of different deals. But I don't think it'd be like the best structure here where it's just like clean, like you're in this one deal. It just creates a lot of extra, paperwork. And can just be confusing, especially to the lenders. And here we're trying to make sure it's extra clear. So there's Avestor. Oh, and then on the investor portal side, there are very few companies, maybe outside of like Avestor, that actually will do the entire setup. So we're forming the LLCs. We are doing all the legal docs. We're going to do the compliance with the SEC and states. We're going to set up the bank accounts. There are now a number of companies that will do the investor portal where, you can, when you subscribe to the deal, signing documents, transferring money and all of that. And so there's companies like Agora, InvestNext, Cashflow Portal, Juniper Square are some of like the bigger names. And so we compete with them on the investor portal front, but we don't often compete with them as much as you'd think because so many folks are focused on this other part that we give them at a fraction of the cost, same level of quality in a fraction of the time. And so then and then our investor portal, they get the same functionality again at the fraction of the cost because we have a unique way we bill, which we bill by deal. So it's more scale as you go. But those are some of the competitors we see in the space. Candidly, the biggest competitor we have are just your traditional like syndication attorneys, right? Beth would like meet them and then she would go and have a couple hour call and answer questions. And what we found is that your cost is going to be a lot more than what we end up charging. Your cost is uncapped. So Beth is walking into like an uncapped bill, which if she's only making so much on the deal, she can't afford to do that, nor would she want to pass it along, especially if it's not known. And then typically the attorney, not all, but most, will just overcomplicate it. And so what we have done is we've like really streamlined the documents, and I've done the brain damage with my team of like, all right, what does someone in Beth's situation or Robin's situation or whoever else is capital raising here need, and what do they need? What do their lenders need? And we've built all of those. And so we have like, 30 plus, 40 plus versions of the documents behind the scenes, and we're adding more every week. So that we've got an arsenal of docs behind the scenes. So whatever you come and ask for, Denise, so you ask for a specific set, right? That's a very, being able to make multiple investments. There's changes that are already made to support that. So that's where, that's probably our biggest competitor.
And then Gina had asked about fractional. So I know you and I talked about this a little bit the other day. So can you cover a little bit about the differences between what you guys do and a company like Fractional? And I think there was another one that we talked about too.
I I know fractional, but I don't know who the other one would be. Um, so okay, I think probably TribeVest. So
Yeah,
fractional.
that was it.
So let me start with TribeVest. TribeVest focuses on like a fund of funds model. So they are looking if Beth was raising for Robin's deal, Beth could go there and check them out. But the problem with that is that Beth would need a deal that's already set up as a syndication. They don't do the parent level deal. So we are the only company out there that I know that will do the parent level deal docs and full setup. And if you want to do a deal beneath it to write a check into that deal, we'll do it too. The parent company deal is 10x more complicated than this deal. And so they only focus on the bottom one. So unless you have someone that knows like has a different setup or is using us for the parent level deal, for which I think this is newer for this community, that wouldn't work. And then the other thing I can say is just they're not, a lot of it's done by hand. A lot of it's done, on Google Sheets. I've gone through the process. And in different, it's not productized like we have ours. So it's like it's not as streamlined and easy as ours is. So that's like the biggest difference with TribeVest. And it's not as customizable. I mean, Beth, as when there's deals, like, there's a ton of different things that, a borrower could ask for, and we're able to incorporate almost all of it in our docs. I've seen the TribeVest docs, and there's a lot less things that you're able to do. So, at the end of the day, like I've never seen anyone be as flexible or have so many options as we do, which is like, a big muscle we've grown, over the last couple of years. And then fractional, I didn't even call them out as a competitor because they are helping you raise under a completely different regulation. So we help you raise under what's called Regulation D. And it is, if you hear of like any syndication in the US, 95% are being raised under Reg D, um, subsection 506B or 506C. So you can feel free to look those up, but that's how like any deal, regardless if it's a $500,000 deal, 100 million or $1 billion deal, like that's how they're being raised typically. Fractional is helping you raise under the investment club exclusion. So if you're like an investment club, which, I don't know the exact definition, but it's a group of people coming together to invest, you're able to make investments, and you're able to make them without having what's called a PPM, which is a private placement memorandum, which in every syndication is required by the SEC. And if you were investing in a deal that we set up, there would be one. And so, one, they don't require you to have a PPM. They're helping you raise under a different act, which is like not as it is seldom used, right? So that's what their way of innovating. It's for some people that's fine. I don't like it because it is not as by the book and very clear, right? And I would not want to go awry of the law. And I'm not saying that they aren't by any means. I just don't understand that way. And I don't like not having a PPM. I see it as a con, not a benefit, because it provides less disclosure to you as the lender. A PPM is disclosing to you as the lender all the risks that you are assuming by making this investment. And so if you look at our docs, we're saying, hi, Sarah, here are the different risks of making an investment into this entity. And so that requires Beth to come to us and get the right version and properly disclose, which should give you more information to make your decision. And so by not having that, some could say, oh, it's like less work for you as the capital raiser, but it's not good in my eyes for the lender. It actually gives you less information. And the other thing that is very different between us and so again, I'll never say anything bad about anyone. It's just picking the right model for you. I don't know I don't think they also have to file with the SEC, which worries me because you better make sure that you're doing it properly. Otherwise, if you're not, then they could say, oh, you like did it the wrong way and you really should have filed. And then you could have fines or legal action by the SEC. So I would rather do it the traditional way that 95+% of deals are done in the US and file. And every deal we do, we're going to file with the SEC. You're going to be able to look it up. It's going to be the name of the deal. Best name will be on there, whoever the capital raiser is. And it's like, hey, we sold securities. They're exempt under Reg D, subsection 506B. Here are the amounts, the states, the date, like it's all there. And so that we did what we were supposed to do. And so I'd rather have that than not. So that's protecting both, the capital raiser and you as the lenders. And then the other thing is our pricing model, right? So we are a flat fee to do the entire setup. It doesn't matter if it's a $500,000 deal or a $5 million deal. We don't think it is fair to charge more if you're raising more. It's the same amount of work for us. Literally, like a $5 million deal is the same amount of work as a $1 million deal for us in terms of setup. So we don't vary pricing. We don't think that'd be fair. Fractional charges 3% of the amount raised, billed back to the lender. So it's for the capital raiser. They're like, it's great, you don't have to pay anything. But what the borrowers either, I don't know if they realize or don't realize, is that you invest $100,000, $3,000 is actually being taken as a fee and not sent to the capital raiser. And so their fees, they're making, the more you raise, the more they're making. But I would argue that they're probably doing the same amount of work. And so, I met some people at, BPCon and they were like, hey, like, we're raising $3 million. And I'm like, oh, well, this is how much it's going to cost you. It's going to be $60,000 billed back to your borrowers. That's not good for the borrower. Wouldn't you rather pay us a fraction of that? It's a flat fee that up front. And it's more compliant. I'm not gonna say it's more compliant, but and we're gonna file with the SEC. You're gonna have a PPM, so it's gonna cost less. You're gonna have the deal's gonna be filed with the SEC. You're gonna give more disclosure to your investors, which I think is more transparency is always better. This seems like a no, they're like, oh, this seems like a no-brainer, and now they're a client. So I would say those are the two differences or two different other competitors, if you will, and how we're different.
Thank you.
See if we have any other hands raised. So does everyone understand this structure? Perfect. Okay, and the other thing I wanted to chat about is the difference between a 506B and a 506C, just briefly. I think
I
I
think that
know
would be helpful.
we were going to talk about some different industry terms, and you might have heard me throw these out. And just if you're learning about syndications, like these will be thrown around. So 506B and 506C are like subsections of what's called Regulation D that are allow you to sell securities, right? That unit in the LLC here, you're selling units in this LLC, those are considered securities. So anytime you are, and this is public based off of, on the SEC's website, that if you're selling a financial instrument that is very similar to another one, like if you're selling the same instrument over and over, that is for someone's buying for financial gain, part two. Part three, that that is sold to a passive investor, right? They don't have decision-making rights. They're not involved in controlling the entity. That's considered a security. And so someone, I think earlier in the call was like, hey, how is this more compliant? And one way it's more compliant than doing a traditional promissory note is that as with the SEC, there's no black and white answer to many questions. But if you look at the first part, like if you're selling a similar financial instrument, that is part of the definition of a security. But if you're raising $1 million and 20 people invest $50,000 a piece, one could argue, well, what is many? Is it 5? Is it 10? Is it 20? Probably definitely 20. Right? So like, if you have 20 people on a promissory note, like you could be getting into a gray area of like, oh, are these securities? Which you could still do it in that way. You would just need to register with the SEC and tell them, hey, I followed all the rules for 506B and 506C, and that would be fine. So it's not that structure is bad. It's more just like, does it trigger a reporting requirement? So 506B and 506C say you are selling securities, but they are exempt from registration. And so the difference between 506B and a 506C are threefold. In a 506B, this is when you've heard like, oh, I've raised from friends and family, that they are doing a 506B offering, right? They are raising from people that they have a pre-existing substantive relationship with, is like the SEC jargon, right? So if you do that, you are not soliciting the public. So in a 506B, you're not allowed to host a webinar with people that you don't know and say, hey, like, do you want to invest in my deal? You can't post on LinkedIn or anything like that. But in a 506C, you can, right? You are allowed to solicit people you don't know and say like, hey, this is my deal. If you want to invest, let's talk. In a 506B, you can have, this is the third point, up to 35 non-accredited investors. So you're allowed to, if you're not an accredited investor, you can allow a certain amount into your deal. And then in a 506C, you cannot. And then in a 506B, this is the second point, the way that those investors have to verify they're accredited is they just select a box in your documents. And then in a 506C, they have to actually upload documents to prove that they're accredited. So those are the different ways, the three key differences between a 506B and a 506C. But really, like, you're just using them to say like, hey, I'm selling securities, but I don't have to go, register them, which is when a company goes public, they're registering their securities, which costs a lot of money. So we're definitely not doing that here. I figured it would be good, Beth and check me here. I know we got a little bit of time left to just maybe talk about why this structure is good for the borrower and why it's good for the lender. Should we just roll to that?
Yeah, that would be great. And I wanted to add to while we were talking about the 506B and 506C, it's been an eye opener again for me because first of all, I didn't even know what an accredited investor was, a year ago or what have you. Like, so one of the biggest things is the way that as a capital raiser, I market the deals that I'm working on because I didn't know that I couldn't just say, hey, I have a single family 3 bedroom, two bath, blah, 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 looking for rehab and we need this, this, and this. I didn't know I couldn't just put that on LinkedIn or I couldn't just put that on Facebook. But following Amy, again, Amy Majori, and how she posts things, she can reference success stories or, we have deals similar to this or whatever. You can do very broad to be able to grow your potential client base, but at the same time, like you do have to have that one-on-one relationship with them to be able to do the 506B versus C. And I think the majority of the women I work with who are private money lenders are non-accredited. So it's important to know like the difference there on how you promote your deals, even if you're a borrower on this call, and you are just throwing it out there for anyone and everyone to see because I see it a lot. Just to be super careful with the way that you promote that you're raising capital for one of your projects. So that's
Lovely.
Yeah, I just searched what does it mean, the accredited investor, because as you said it, I had no clue. So it's pretty, I mean, you have to have over 5 million in assets and earn 200,000 plus per year or net worth over 1 million. So that's already quite
So
significant, right?
I would agree with parts of that, but I'll copy at one. So there are two different ways. So there's an accredited investor, and then there's what's called a qualified purchaser. Those are two different ways that you can be able to invest in a syndication. The qualified purchaser is much more strenuous, and that's where you got the $5 million. And so that's not a part of what we're doing here. We'd be helping you raise under a different subsection. So we'll take that out. To be accredited, you need to either have a $1 million net worth, excluding the equity in your primary residence, or you need to, if you are single, not married, per your tax return, make more than $200,000. And if you're married, that it jumps to $300,000. So that is why, a lot of the deals can be done under, 506B, as Beth was mentioning, because you're allowed to accept non-accredited investors. There's some more requirements, right? Where that person who's not accredited writes, in the docs, their investing experience and why they believe they're qualified and sophisticated enough to understand the risks and potential rewards of investing in the deal. And then the capital raiser ultimately signs off and says, like, yes, like this, I believe that this is enough. Like, what you're investing in and getting into. Okay, so the benefits to the borrower here are that they're able to continuously accept investors, right? So if Beth were to kick off a deal today, and she was using the promissory note method, and there were 10, she's got to line everyone up. Everyone's got to commit their amount, what entity they're investing through, all of it, and it's all kind of a mad rush at the end. Who's experienced that? Okay. I see a couple other hands. Yep, Gina, thank you.
for sure.
So, in a syndication, once the deal is launched, every investor signs his or her own set of docs. You do not sign the same set of documents. So, Denisa, if you want to invest $100,000, you have your own set of docs that only you will sign, which means that when we go to the self-directed IRA company, if you're using a self-directed IRA, they don't need to know all the other investors that are investing in the terms and all of that. As long as the terms are finalized, Beth is able to send you documents immediately. She will be able to go in her GrowIt account, click a button, put in your name, email, and an amount. You will get an email. You will be able to go on and in one sitting go through your compliance checks, sign your docs, and you'll get wire instructions to wire your money. So that makes it so much simpler because one, as soon as you commit, you are able to sign docs and transfer your money. And two, it means that self-directed IRA companies, if you're using one, it is so much simpler. If they just have one set of docs or they're only one signing, they don't have to like know who all these other folks are. We just had a deal recently that had 17 self-directed IRAs. 17. We had no issues, right? Like they were just, we have you sign the docs. We send you the direction of investment. You sign it. We work with all of them. So we've got our own processes of like, okay, how does this company ask for the documents to be titled? Like we have all their forms. We have our own contacts. So like one, we've got the relationship and we're doing this all the time, and they're used to the syndication docs. And then two, that also takes a ton of work and time off of the capital raiser's plate. But at the end of the day, what matters most is it allows deals to close, right? And not have everything get to the last minute and everyone's stressed and we don't, and we end up losing some deals if that happens. So we actually have two or three other people from this community that are using us for deals for the exact, like they lost a deal. Or they came to the very end, where they almost lost a deal, and they love the structure because they're like, oh my gosh, someone commits money. I can, that person wants to put it to work. I don't have to tell them wait 30 days because the moment that you wire your money, you start earning, whatever the documents say in terms of like your return. So if you want to put money to work and you say yes, the capital raiser can click a button, add you, and you can go through and sign docs and transfer money same day. So allows you to start making money quicker. It allows the capital raiser to continuously raise money, which sometimes the deal doesn't need to be fully funded for it to close.
Yeah.
Right? Like maybe it's a $1 million raise, but to close the deal, they need like 600. Well, they can just keep raising until they can use the 600 to close and then raise the remaining amount after the fact. I see it all the time. And so that's pretty common. And then additionally, this structure allows for larger capital raises. So I think we were talking about beginning, Gianna, you mentioned like how, it's kind of a scary word, like how do we stay compliant? And this is actually, I would say, as you have more and more investors can be more compliant than maybe historical methods because of the number of investors and the definition of a security we had before. You're definitely not going to be out of compliance. No one's going to come and say like, hey, you didn't do this the right way. If not, it's more by the book. And so it allows more investors to come together for a deal. And then also, it allows typically for longer, typically a larger raise can also mean that the deal is a longer term deal. And so I think we started the call with Beth saying like, hey, I think a lot of people don't want to have to reevaluate a new deal every 6 months, and you make great money for 6 months, but then you might not have that money deployed for 2 months, and you got to do all this work. Like, we want to provide some consistency, and so typically these types of deals, you might be in for a year and a half, 2 years, etc. And so, if that's the case, you could, if you think about how much you'd make in 6 months, if you usually hold for 6 months and then you're out for 2 months while you're waiting for a deal to close, or God forbid something happened and the deal didn't close and you had to wait for another one, that's 6 months in 18 months that you're saving. And if you just think about how much that money would have made you in 6 months, like it adds up, or it's going to be a lot of money. So those are a number of ways that it helps the borrower. And then on the lender side, you're able to make money quicker. You don't have to wait till everyone's lined up to sign. You have to sign less. If there's changes to the docs, you don't have to re-sign documents. And then just this is less about syndication and more about GrowIt. all of your investments will be in our platform. And so you're going to be able to go and see all of your what are called distributions. You can see you're in 3 deals currently and how much have you received, when did you receive it, how did you receive it, et cetera. So it's all going to be, very streamlined for you.
There's
Uh,
so many things I want to add, but I know we're getting close to our cutoff. But so just like real life examples, and you did touch on this, but I just want to like reiterate. So, you have a really huge project that you're trying to raise capital for, and again, like maybe it's $1 million raise, and like Lucas said, the purchase and maybe the closing cost and maybe like a draw or something like that's 600,000. As soon as you have that 600,000, we're clear to close. We're not waiting for somebody to get back from another deal that was supposed to close, and now it's in an extension period, and now the self-directed isn't doing whatever it needs to do or whatever. Like, you aren't going to lose a property because you have the capital you need to close, and then the other remaining 400,000, or let's say 350,000, can trickle in, which means as a borrower you might potentially be saving money because some of your borrower or some of your lenders aren't even in the deal yet, but you don't need that draw for another 2 months anyway. So that money comes in at some point over the next 60 days so that when you have your next draw, you get it. Now, for me, I want everybody in there and I want it over with and I want to move on. But this is the opportunity to not lose a deal because you can't close it. And that's my big thing is I don't want to disappoint borrowers. I don't want to disappoint lenders. Lenders are hanging out waiting for 30, 45, 60 days, waiting on everybody else to bring their money. So they just lost 2 months of interest. So now a borrower feels like they have to make it up to them. So now they're going to give them extra points. Well, now the documents look different. Now people are questioning why people are getting more points and all of that. Like, it just simplifies things so much. And truly, I can think of 3 different deals just in the last probably 60 days that had we had this set up, things would have been so different. It doesn't mean we lost all 3, but for crying out loud, it would have made it a much better process to not be jumping through hoops at the last minute. So, oh, I just
yeah,
dropped something.
100% agree, and I've seen it with multiple people who are switching to the structure. At the end of the day, it provides just so much more flexibility. I saw Robin, I think Cherry in the chat, right? Like, imagine you're in Robin's shoes and she's underwriting a deal and she's got to move quick. She wants to close. She got a good price and she wants to have it's a good deal for everyone that's investing. But if she says, "Hey, I need 1 million," that could change. Like, I need 1.15 because something else came up or there's a new opportunity. But if she's already closed, then she can't, increase the size of the promissory note. If she needs an extra 150,000, she can tell Beth. And if Beth has someone that wants to put in the money, she just invites them and they subscribe because it's not all locked in at a point in time. Like, other people can be added after the fact until Beth is like, all right, it's like it's done. And even when you say it's done, it's not necessarily done because you're selling a unit. So you can always add more units, which means everyone will end up owning a little bit less. But if that's accretive or good for the deal, right? If something happens, as we know stuff happens, it just provides so much more flexibility to get the deal, just the amount of capital it needs to provide the best return to you as the lender, and for the operator to do his or her job, and so everyone wins.
I
Definitely
love
agree.
it. Anybody have any other questions?
I do. So it would be like a basically combination of Beth with Lucas. If I have like a 1 million project, like Beth, you would help me find the investors, and Lucas would help to organize and basically do the setup. Is that correct, or am I understanding it correctly?
You want to go first, Lucas, or you want me to?
You go ahead.
Okay. So I raise capitals, and you and I have had conversations. You've been on Private Money Mondays, several times with different borrowers. So I raise capital, and I'm not directly affiliated with Lucas's company. I just have found that his company does things that my borrowers need. And I feel like there's another layer that is actually helpful for lenders as well. So bringing him on tonight and kind of talking through the syndication process for both the borrower and the lender perspective, I just thought it would be super helpful. And if you wanted to deploy and work with Lucas, by all means, like I highly recommend. And then you and I would have a different conversation about raising capital for your deal. Since you and I have not worked together in that capacity, you've been a lender conversation, not a borrower conversation. We could certainly talk through that and what that looks like and go from there.
So, Lucas, you are also helping to get the investors on board?
No, we are
That's
the
my point. You see,
Okay.
Beth, like if I'm not like if I'm somebody who doesn't have the network of basically investors, so and I come to you and I say, I have this $1 million project that I need to raise money for. Um, I was wondering if Lucas is not only setting up the syndication, but also helping to get the investors on board, which I think is your role, right, Beth?
Yes. I
Okay.
would work and help you
Okay.
raise the capital, but we
Awesome.
would work I would prefer that we actually work with Lucas's company to help us streamline the process,
Okay.
help us with documents, help us with self-directed IRAs, and then just keep it compliant for both the borrower, the lender, and me as a capital raiser.
Makes sense. And it looks very organized and clean and streamlining the process. Yeah, definitely.
Wow, I've
Very,
impressed you, and
very good.
I haven't
I
even
know he
shown
hadn't
you
even
the
showed you
product
the
yet.
portal yet.
Yeah, we
So,
can.
it's so nice.
I know we're already at time, but I could show you if you guys were here. Well, we can
They
take.
can hop off if they want, and it's being recorded, so they could fast forward to the last few minutes. But I'm fine to keep going forward, Lucas, if you're fine with keep going. And like I said, it's recorded, so we'll get all of it in there. But if people need to drop, that's perfectly fine.
Yeah, I figured maybe just if there's more questions, I'm more than happy to stay on, but maybe I can just show you what it looks like to invite an investor in case you're looking interested in doing your own deal. And then if you are a lender, what you will experience. So feel free to jump in with any other questions. I can multitask and answer both. So just feel free to ping me. Okay, so let's say that I'm raising for this Echo Capital deal. You will come into this member onboarding tab. This is your fundraising dashboard. So this is where you as the capital raiser invite an investor by putting in their name, email, and the amount you want to let them invest. In this investor onboarding table, this is every investor that's in the process of investing. And then the exact status that they're in. So there's 5 steps investors go through, which you'll see here in a second. And so you can see exactly where they are in the process so that if your deal is closing in 2 weeks and someone hasn't even created their account, you might want, you can nudge them and say, hey, Matt, time for you to create your account and get going. So yeah, you're able to see all five statuses here. And then down here you can see all the investors that have completed their investment, right? They've signed their docs, they've transferred their money, they are earning their preferred return. So you want to get as many folks from, this is your funnel, everyone in this table down to this table down here. And so the actual process of inviting an investor, one, you can create a deal page, right? So you can create a public, website that looks like this, right? Where an investor is able to see all the information regarding your deal, and then they actually can just click invest now and start the process that they want. Or if you prefer to invite people, investors individually, what you do is you come here and let's see, who wants to be a lender tonight? Gina, you want to be a lender? All right, so Gina is going to invest. Gina, how much are we investing tonight?
Both dollars. No,
Both.
12?
500,000.
$500,000. All right, we love it.
Much
Cool.
appreciated. Thank you.
My
All
pleasure.
right. So you can see that you're automatically added to this table down here. So if Beth was inviting you, she would see you here. You just got an email inviting you to set up your GrowIt account. 30 seconds, username, password. You'll log into your account, ignore all these green bubbles. You'll just have one green bubble next to investments. And then you'll see here that there is this new pending investment that just came in a few seconds ago. And so you're going to go ahead and click start. And then these are the 5 steps you go through to fund your investment. So you can see as the lender exactly where you are in the process. And so you're able to do all of that here. So as an example, you're able to decide, so Gina, are you investing in your name personally or through an LLC trust? LLC?
She shook her head. Yeah.
Okay. So
Yes,
if
my
you
LLC. Sorry, I couldn't hear my head rattle.
so you would come here and add your LLC, right? You would select LLC, put in the name of it, some other key information, and you'd be able to select it here. So this is my LLC as an example. Then you go ahead and accept your invitation. You next move into the compliance task. And so here we ask you for, the business address for the entity, which I've already submitted. You just click submit. The next you go to the accreditation task, which is we need to make sure you're an accredited investor, or you can notify and say you're not an accredited investor. So once you've confirmed if you're accredited or not accredited, you move into this document signing task, which you would have just received an email in your inbox with your document package,
Man,
right?
this
So your
eliminates.
operating agreement, sorry.
Oh, sorry, nothing. I was
So
talking to myself.
you'll it's okay, I do that sometimes or every day. But you all the documents you need to sign will be there and we streamline the whole thing for you, right? You sign your operating agreement, you sign your subscription agreement, we've auto-populated all the stuff that needs to be pulled over to make it as simple as possible. And then once you've signed, it goes to the capital raiser for counter signature. And once she is signed, you'll get an email saying, Beth has countersigned the documents. They're in your account for your review. Please log into your account to transfer your investment. And then you'll log in. You'll be in this 5th step, and the wire instructions will be there. You can download them or click a button and be able to see them in your screen. And then you can click a button that says, I've initiated my wire, which will notify Beth. So Beth can say, oh, like money's on the way. Like what sensitive, right? I want to make sure I'm watching the bank account, today or tomorrow. And then she will be able to confirm, right? So once you've clicked that button and she's notified, once she receives your wire, she's able to come here and you'll notice that she can come here and mark she's able to mark your funds as received. And when she does, then you're notified that she's received your money. There's a little congratulations email, and then you move down here into the what's called the cap table.
I
So
mean, that's really genius because on this last raise, I actually changed the wording to say that your interest would accrue beginning the date you transfer your funds instead of the date of closing, because this one's already been delayed, 2
Yep.
weeks. And it's like, some of the people had their funds in there already. I wanted them to be earning, so I just changed the wording,
yeah,
it this just does it for you. It's amazing.
yeah. Well, the
Love it.
docs will say by default that the date you receive their investment, they start earning. And you'll actually notice when you mark their funds as received, we ask you, what date did you receive the money? Because that's the date that when we calculate, we are actually going to calculate here in this distributions tab, right? We have what's called your waterfall. And so that is how profit for this entity is distributed between the manager and investors. And so, Gina, if you were running a deal, it'd be as simple as, you come in and say, January 126 distribution. And then you say how much you have to distribute. Let's say there's $25,000 of interest for the month on your raise, and you want to send it back to investors. You select your waterfall. Usually there can be 1 or 2 for the deal. We can talk about that when you come and we chat about your deal. And then let's say you're like, hey, I'm going to pay interest through, January 30th, right? You're able to come here and click create. And then you see that we automatically pull in every investor. We then say, here's how much they're due, how much, there's only one investor in this deal, which usually there'd be like, 5 to 20. But then you can come here and click and it will show you, okay, of that 25,000, here's how much they get in a preferred return. We've already done all the math for you automatically, so you can see exactly what the formula was. The lender is going to be able to see that on her end too. So she doesn't, if she asks you questions, you can say, hey, GrowIt did the math. You invested 250,000 on this date. You're getting 7%. Here's how many days. Here's how much you get. And then the rest would be like in this waterfall return of capital. So I'm happy to walk you through a waterfall, but basically, if you use our platform, we then are going to streamline all the distribution math for you, right? So we set up the waterfall. We're going to process all the payouts. And if you click approve here, your investors can have their bank account linked. You link your bank account, which we've set up for you. And then if you click approve, we will automatically transfer the money from your bank account to the lender's bank account via ACH. So you click, enter 4 questions, click approve. We then transfer all the money. So you don't have to go send 10 ACHs every month to get them their money or quarterly, right? Like, it doesn't matter if you have 20 investors, like, you don't have to worry about going and doing all of that busy work. Like we've automated that for you and made it very easy.
That alone is worth the fee, in my opinion, working with so
Amen.
many borrowers.
Amen.
I
Yep.
mean, you've got borrowers with 5 deals going and they've got 4 to 7 lenders on each of those deals. And now you're trying to figure out how to do ACHs manually. That alone is worth the fee for sure.
So
Yeah.
what is the
Um,
fee?
Go ahead.
What is the fee?
We charge $1,200 per year per deal, Denisa, if you are not using distributions, right? So, and then it's $600 a year per deal, additional per deal when you turn on distributions. So if you have a deal that's not going to pay out for a year, is going to pay out at the end, we don't bill you the $600. When we start doing the math automatically and transferring money between your account and their accounts, and you're getting value from that, that's when we feel it's fair to charge that additional amount.
So worth it.
But then so I want to be clear. So that's the fee for that. But the overall fee to use GrowIt for docs and everything else, that's not that fee.
Like you mean for the setup?
For the whole setup, correct.
Okay. Okay.
Correct. Yep. Yeah, so the $1,200 includes everything you see up here except for distribution. So you'd be able to set up a deal page, right? So we host your website. You can come here, answer questions, and in 3 to 5 minutes, you are able to have a public facing website you can send out to an investor. As an example, we had someone from a different community. They're doing boutique hotels, and she signed up with us on Friday, and she created her deal with us over the weekend, and she had her first investor call this afternoon, and we had her all, I configure everything on the back end over the weekend, and she made her deal page Sunday, and it's I wish I could show you. I mean, I can't because it's private, but like it's a beautiful deal page with pictures and her deck and all the information. But and she used it on her call. She was able to show people and just had all the information. And then she literally could, as an example, like this is one that I made. So she was able to go in and fill out as many or few of these fields as she wanted. We auto-populate, the page, and then she clicks publish, and then she has a link right here. And so she could just click link, and then she could drop it in the chat. She's got, I don't know how many people she had on her call, but she just dropped it in the chat. People could go and look at it later, share with other folks, click invest now, and start investing. So you receive deal pages, the member onboarding, right? So that $1,200, these includes being able to invite the investors. And then you might recall when the investor went through this process, When they went through this KYC, KYB verification, we ran 150 different compliance checks on that entity or that individual, right? So we're making sure that if you're taking money from someone you don't know, that they're not on a government watch list, which is a legal requirement when you're taking someone else's money in the form of an investment. And so we, of course, will not send out documents unless they've passed, right? But we've done the heavy lifting on the back end to ensure that they are not someone that's flagged for laundering money, etc. And so that's included for up to 100 investors. You can have up to 100 investors in a deal like this. And then the accreditation piece, we also do and keep track of that for you in case you're ever audited. We're going to have that document signing. We work with DocuSign. And so industry leader, you'd be able to see, in your account or the investor, like the DocuSign modal, they're able to sign. Like we have to pay for all of those. We have to pay for every check. So that's just included in the $1,200. And then also, there's the last piece is more software, but being able to host your wire instructions. So that's all included. And then a couple other things. One, you can send out communications to your investors, right? So like imagine, Gina, wow, is it Gina or Gianna? Gina? Okay.
Gina.
Okay. Um, I think I was getting that wrong for half the call, but so you're able to, let's say you've got 5 deals going. You come here to deals, you're like, all right, I want to send out an update on Echo Lake Capital. You come to comms, you click new message.
That's so
You're like,
cool.
I want to email all investors.
Updates right here.
Yep. Like it's going to pull in all, 20 emails. When you put in a subject, body, attached documents, click send, and you're done. We're going to send an individual email to every investor with you on CC. So if they reply, it's an individual thread. It's not like they're BCC'd and then, there's this big web of responses. And then lastly, this is called your capitalization table. So this is a list of all the investors in your deal, right? The actual investor listed on your deal is this investment vehicle, right? This was the Gina Bonds LLC, Denisa Jahul, kind of. Okay, I butchered that. This is the Denisa J IRA, uh, and Lucas Parelius, the natural person, right? So you can see how much they invested, how many units they have, what their pro rata ownership is, which this will go up and down as you add new investors, right? And so that's all included for that the 1,200.
All right, so let me ask a big question. So let's say the deal goes south, and now how what happens in that regard? Like in traditional lending, if the deal goes south, they just foreclose out, they get the property. What happens here?
So it depends on the type of deal, right? So um, if let's say that you raise the money on your own, you raised your own money, like let's say you're buying RV parks and you raised money and then you went and bought a property. Well, the property is owned by the holding company. So, right, like that asset would be able to be sold and whatever cash is left, is going to be distributed back to investors. And in the waterfall, this is an example waterfall. It says that typically the members, the investors, lenders, same thing, get their preferred return. So think of this as like your 12%. Then once they've got their 12%, they get all their money back before the manager makes anything, typically. So
Right.
maybe there's not enough money to give everyone all their money back, but you would sell the asset and then run the money through the waterfall, and hopefully there is enough. But if there's not, that's how it would work. If you had raised money to then provide a loan to someone else who then use that money to buy the property, that is typically going to be backed by a mortgage or deed of trust. And so this manager, her job is to act in your best interest. And so if they are not making their interest payments, she can then go and foreclose. And it's her job and her responsibility. That's part of the reason she's being compensated to then do what's necessary to go take control of the asset and sell it or turn it around if she wants to take control of it and turn it around and raise more money to finish whatever was started. But typically the loan would be secured, right? And there would be an asset behind it.
Right. Gotcha. That makes sense. I love this. Thanks for taking the time explaining it because I have much better understanding and this is love it.
Good to hear. Gina, do you lend? Do you capital raise or both?
So I'm a capital raiser. And I just raised, well, I'm currently raising 525,000. And I'm in that exact situation that you were talking about. Like I literally could have closed 2 weeks ago, you know, and but one lender, Sedera funds didn't come in. And so now it's like, wait, so now you push the date, when really we could have already closed and everyone else could have already been making money. So it's very timely.
Yeah. Yeah, we had a deal with someone else where the lender, he got delayed a month, and the lender finally, said to the IRA company who's dragging their feet, it's like, if you don't send them money in the next 30 minutes, this deal is going to blow up. Yeah, do you want to be part of that? And anyways, they wired the money. It was like the last check, but everyone was in for a month and they weren't making
Yeah,
it, which was
yeah,
very
it's
frustrating.
crazy. It is
Um,
frustrating.
yeah. Okay, well that's the investor portal. That is how you syndicate a real estate transaction, or really you could raise money for anything. We can do loans that are backed by real estate. You can be buying an asset directly. Typically, if you're raising 500,000 or more, this begins to make sense where like the fee that we charge, like actually it's like, okay, like this can be borne by the deal. So yeah, typically we see folks. I mean, we've got a deal right now where they're paying and it's 350,000, and they're like, I just want to close. We're going to make so much money on this. It's more of like a development deal. They're buying land and then entitling. So they're like, this is a win. Like, help us close. Like they came to me like, we're closing in 2 weeks. Can you get this set up? And they're closing a week from today. And so it's
So,
all been set
so
up.
that's amazing. So you can do any kind of asset. You can do you can do ground up builds.
Yep.
You can purchase property, you can do land development. That is I love that.
Yep. I mean, there's different versions of the docs, which is why behind the scenes, we've got all the different versions. And so if we ask you, what are you buying? Are you buying land that you're going to entitle? Or are you buying multifamily, self-storage, industrial, retail, triple net lease, office, like you name it? Like we've got the right disclosures and versions of the docs. And then also the strategy you're using is important, right? Are you going to develop, meaning you're starting with dirt and you're developing, or are you going to redevelop, meaning you've got a structure that you're gonna improve in some way that, at their additional disclosures you should put in to tell investors like, hey, like we're not buying something that is cash flowing day one. Like there's execution risk here of us not being able to um, do this properly or on time or on budget, etc. But yeah, any subsector of real estate, we've probably seen it. I see lots of deals. So
Yeah, so I mean, I feel like this is kismet. I was in Arizona doing, learning how to underwrite mobile home parks and RV parks, and it's very interesting how they structure. And usually in those type of situations, you're going in to something that it was not operating at its optimal operation, and so you're going in to improve that. which of course value adds. And there may be some physical improvements, but most of the time it's operational improvements for the most part.
Yep, we do RV.
So
We've done a number of RV parks. There's a lot of self-storage, a good amount of RV parks, single family flips of all sizes, multi-million dollar flips, $500,000 flips. So, if you're
yeah,
raising money for real estate,
Beth, there's a house in pre-foreclosure in Savannah that's 1.5 million. I was looking at it yesterday and I was thinking, boy, if it wasn't in the millions, I'd do this house. I'd flip this house. Now I'm thinking, why not just do it?
Why not just do it?
Right.
I got you in Savannah if you got stuff going on.
any final questions, Denise? I think you might have one more.
To say thank you. Great presentation and very clear.
Very good.
Thank you.
Perfect.
Happy to hear it was clear. Well, I'll drop my email in the chat if you have any questions. More than happy to connect at any time. Or you can go to our website and check out almost most of what I shared should be there. And set up time if we can be helpful. And just want to say thank you again to Beth for the opportunity to come and talk about syndications. Like, this is what I now do for a living, and I love helping deals come to life. And like I said, I see lots of different deals, and so anytime I can be helpful and share like what I'm seeing in terms of terms, what's getting funded, what's not getting funded, feel free to reach out and use me as a resource. I will shoot you straight. Whether you'll like or not like what I have to say, is up to you, but I'll tell you what I really think. And let's go do some deals.
Yeah.
Awesome.
Love it.
I will be there for sure.
Yeah.
I missed. What was that?
Just saying, I will be in touch for sure.
Oh, okay. Got it.
Perfect.
It was muffled. Got it.
Perfect.
Well, Sarah, hopefully, I think you're in my stomping grounds. I think I saw you're from Santa Clara. I grew up in San Jose. I went to Bellarmine, so my whole family went to Santa Clara except for me. I decided to leave. But come say hello at some point if you are in Santa
Yeah,
Clara.
no, yes, I am. Thank you. Yeah, I know. Bay Area, born and raised. So, yeah, Bellarmine's down the street.
Yep. All right. Well, I think that's it, Beth.
Thank you so much. We've been going strong for 90 minutes. We could probably keep going. So thank you again for that. I appreciate it. Any last questions, anybody, that you have for Lucas or for me? Otherwise, we'll go ahead and call it a night.
Thank you so much for this. It was very informative.
Perfect.
It really was. Thank you.
Thank you.
My
Thank
pleasure.
you,
And I
guys.
do mean
Bye.
it. Please take my email if I can answer anything. Never expect anything in return. Just like want to help everyone in any way I can get more deals done. So, reach out if I can be helpful or connect you with someone. Whatever it is. I mean, if it's not regarding this, like odds are like I've, got the lender or title company or something. You need, some tax, let me know and I'll fire off an intro.
Perfect.
Okay.
Thank you.
Again,
Thank you so much. Thank you.
you guys have a good night. Thank
You
you.
too.
Bye.
Thanks, Beth. Good night.
Bye.
Bye.